Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. We're going to rip through Twitter, give you my financial opinions around a bunch of financial topics, wealth building, commodity type stuff that we see on the Twitter here. And again, if you want to follow me on Twitter, you can follow me at finding_finance, or you can join the website. We do talk about individual companies. I do midweek updates, and I also do um, question and answer sessions on the weekends. I also have a big discount coming. My birthday's coming up, and I'm going to put a code in the description link below. It'll be valid from July 10th to July 21st, I think. So my birthday's coming up. I'll give you guys a birthday discount. I'll put that in the comments section below. It's 50% off for the first month if you want to try it. And then you can end it or whatever you'd like after that. It does automatically renew you into it, but you have to stop it if you're interested. So it says, will history repeat? Wall Street says no. And not to worry, stonks are going higher. But remember, they are talking their book. So will they break it again? Fed always breaks something. And I'm not in the camp that just, random stuff breaks. There's certain reasons why things slow down, speed up, and whatnot. Back in 2000, we had an increasing interest rate environment back then, and then we turned and went back lower. That was the tech bubble. The tech bubble, um, we had interest rates come back up. They basically inverted, but they went real high, inverted, then we came back down. They lowered interest rates. During that time frame in 2000, 98, 99, 2000, we that was the beginning of the expansion phase of real estate. But the inventory in that real estate in 2000, 2001 did not go up. It was very low during that entire time frame. They lowered rates, which then blew up a housing market bubble. The housing market bubble, when they brought this back down in 01, 02, 03, 04, it went berserk. So house prices took off when the interest rates went back down. Then the inventory started to explode in the 05, 06 area. That is also when we were building a whole bunch of homes. So we blew up a housing bubble. There was a lot of bad loans that went into the system, and that all collapsed in 2008 was the final collapse of it. But what you want to notice here is the Fed funds rate. They went down with it. The housing market started kicking up. They raised interest rates again. They flatlined for about a year. Then they started going lower. At this point, they knew something was screwed. The inventory was piling up. They were building far too many homes. Foreclosures were skyrocketing higher. It was the combination of all of those things. So when this was coming back down, that's the time to find shelter. Find shelter. Then you can see U.S. job openings were also declining. What happened here is the U.S. construction cycle. Housing peaked, and then housing starts started to fall, and that impacted the construction jobs. So everything kind of fell apart, and we could see this all come down together. We were low for a very long time. This was the recovery phase of real estate. It bottomed in 2012. Then we started hiking again. We came into another hike. Real estate started to kick up. Jobs started to kick up. Inflation, it wasn't horrible, but it was kicking up a little bit. And then we had another crash here. This is the 2020 COVID crash, total blowout to the downside. They lowered rates a little bit before it, too. You can see they lowered it, and then all of a sudden it just went berserk here to the downside. That also was not a housing bubble related crisis like it was back in this one. So I think that we could rebound very quickly. That's what I was thinking. We rebounded very quickly. They printed a bunch of money, and then we could see rates flying back higher. Now, we don't have the inventory of homes. and this is where it gets interesting. If they replicate what they did over here, they're just going to blow up another housing bubble. So I think that's possible if this were to fall and were to come back down for a recession, which it's possible. I'm not in that camp. I remain open to either thing, and we can go sideways for a little while as well. But I don't think it's being driven by the housing market. So I think whatever it is, I think it's going to be like a tech bubble type deal going on. That's my opinion there. So we could head lower. By the time that starts heading lower, that's a lot of the times where you want to find shelter. Another thing that does very well when this declines from a high level downward is gold and silver do very well during that time frame. So this is good for a lot of commodities. All the way up here, commodities start to peak, and then gold and silver start to take off. Gold and silver ripped it from 2018 all the way to, I would say, summer of 2020. As this went up and they started raising interest rates, commodities really took off, and interest rates lagged behind it. That's your oils and uraniums and stuff like that. So if we were to peak and come back down, we could see gold and silver head up to the upside. They're the gift that keeps giving. So this guy says, propaganda alert. Last year, active inventory rocketed up nationwide because buyers refused to pay the inflated prices. Hence, this year, inventory is naturally lower, i.e. negative year over year. Logan trying to push shortage theory to justify overpricing 7 days a week. And this is the gift that keeps on giving, which is we are lowering inventory the entire time. Hasn't broken the downtrend yet. And even if it does break this downtrend, that doesn't mean that we just go rocketing higher immediately. It takes time to build inventory. So these guys that are all bubble this, bubble that, doom and gloom, they're just way too early to be this doom and gloom for the real estate market. The inventory is too low. And if interest rates go back down, they will be wrong, period. If interest rates were to come back down, they're going to blow up another bubble in real estate. It's like the cycle repeating itself. So I don't know how you could be that bearish when you've got no inventory. That's like saying that something at the store that you're buying that you're real bearish that the price is going to go down, but the store is completely out of it. You're like, dude, that's just dumb. Like, I'm sorry, it doesn't make any sense logically. Now they could be trying to say that inventory is coming, but I don't know why you do that if there's no inventory. You just say, you know what, we're out of inventory. How about we just wait and find out, and wait for these numbers to turn, which you'll have a couple of years of heads up anyway. If you notice, we had downtrends here all the way till mid 90s. We came up, but it took years for this to come back up. This wasn't 1 year. This is a couple of years to come back up. Then it came back down. We had a big spike when all those loans were bad and they were building a bunch of homes. We're not building the homes, so I think we're going to stay down there for a while. D.R. Horton, DHI, the nation's largest home builder. So this is more evidence. Closed last week down 5%, but it's coming off 5 straight green weeks and is still trading above its late 2021 highs. No reason to panic, possibly even buy the dip opportunity. Now this guy, I don't know who he is, but you draw a line going across here, that red line he's got, it's just doing a retest move. It's a breakout, then a retest. And yeah, I think it's a good buying opportunity. I think the home builders they're going to do very well. And that's the difference between someone who's a real estate bull versus someone who's a real estate bear. All the charts in the home builders are breaking all-time highs for a lot of them, not all of them, for a lot of them. They're going up towards all-time highs. Does that look like a bubble? Now, a bubble is characterized by home builders making all-time highs and inventory making all-time highs. Now, that's a bubble. We're not in a bubble yet. we got some time, guys. Here's another one. Mike Simonson. He says the housing market is not currently crashing. Doom twits. I can't believe you say the housing market will never crash. You're a shill for the realtors. And Amy keeps writing all of this negative content. I think we're going to see a multi-year, maybe decade-long fallout. Yet all the Twitter economists wearing bibs sponsored by housing industry professionals are calling the race over at mile 3 of the marathon. I don't think so. I think Mike is right. I think Logan's right. I think Amy is wrong. The reason I think she is wrong is because we have low inventory, and it takes a long time for inventory to build. We also have a huge shortage. That's like saying the bull market in uranium's over before the bull market even really ran. You can't. We got to see the inventory go up. Period. Now here's Andrew. He writes, "What $100,000 salary feels like in different cities. Cities where 100,000 doesn't go very far. Where take-home pay is worth least after taxes and adjusted for cost of living. So we have New York here. $100,000 is really $35,791. Honolulu, Hawaii, San Francisco, all these California areas, Boston, Seattle, which is about half down here. It's half of 100 grand. One thing I will say is people are really running uphill living in very expensive states with high taxes. You are definitely swimming upstream. It's a much more difficult area to live in. What I did is I looked at, a highest, I'll call it the highest quality standard of living with the lowest taxes and the lowest cost of living all kind of merged together. So I moved to Colorado a long time ago. It was very cheap back then. In 2011 is when I moved. And it was cheaper. Like the housing market was really cheap back then. Rent was really cheap. The property taxes here are some of the cheapest in the nation. They have a flat sale or a flat income tax, which is kind of normal. It's nothing expensive, nothing cheap. And everything here just it's not that expensive. So I find it a pretty good mix of all these things. I used to live out in California. Huntington Beach is right by Long Beach and by Los Angeles. That was a pain, guys. I did not. I lasted a year there and said, I'm done. I'm out. I did go to school out in California in the Central Coast, but it wasn't too bad there. But yeah, down here it's expensive as heck. I lived in San Diego for a summer too. Here's the metals weekly price and performance. We've got tin doing very well, up 9% over the weekly performance. Cobalt's killing it. Nickel was up a little bit. Vanadium, silver, palladium, platinum, all kind of flat. Copper, gold, flat. Molybdenum, lithium, flat. And then ones that were down a little bit, aluminum and uranium were down a teeny bit. Zinc and lead. And these really aren't down that much this past week. So I would say that's pretty much a win. There's a lot more positive than negative for the metals weekly performance. Here's one. Your employer doesn't look out for you. That's why you need to use your income to stack assets and look out for yourself. I I've been working, ever since I graduated college. I've been working a professional, white collar job, and I was pretty hard working in my 20s, that's for sure. I thought hard work, I would be promoted based off of merit, all of those things, and I came to realize that it's just a buddy buddy show when you get into management, and people are just hiring friends, they're promoting their friends. It's pretty messed up. It's not that much merit based, at least my experience. And then as I got older, obviously you start caring less about things. I'd say that started in my early 30s, and then it went downhill. And when you look at this, there were some pretty bad bosses that I came across that I didn't see eye to eye with. So I started doing exactly all of this the entire time. I was stacking assets and income and doing all this stuff. And it was a lot harder when you don't make as much money when you're younger. But over time, obviously, it's built up. So I think it's psychologically a must to do some of this to kind of protect yourself against the stresses of having a single job. Another thing is to do side hustles and increase your number, no, or the number of sources of income. So if you're getting dividends, you're doing a YouTube channel or something, you start working on other projects and things. It really kind of mellows you out. And then when you start hitting certain income levels or wealth levels, maybe not income or wealth, however you want to, either one, I think it kind of does that to you. If you hit a certain income level or you hit a certain wealth level, or the combination of those two things together, I think you change as a person. Well, at least I did, and I became a lot more relaxed. I became a lot more just kind of mellow. I don't really care. It's like, whatever. You get fired from this job, whatever. It's okay. It's not going to really hurt. That's kind of what it does. It gives you it almost is like fu money, so to speak, but you get a lot more relaxed. You don't have to worry about things as much. And I think that is important for a lot of people because if you're stressed out from a single job, barely making payments, you're going to be a different person. You're not going to be the same person than as somebody who is making the payments, let's say, a lot more easily and isn't worried about the single job. You don't have to have it. I'm not saying that you're going to give no, completely go away, like all of your stress or whatever, but a lot of it does go away. Morningstar makes a bold call that housing market affordability will be restored by 2025. Here's the full breakdown on Morningstar's housing outlook, including its 4% mortgage rate call. So they think that we are going to get a slowdown probably some point here, and that these rates could come down. Now, I don't know if that's going to be the case. I really don't know, but that's their call. Logan again, he says, as I've always stressed out, at least we aren't Canada and many other countries. This is the United States home prices and incomes, and this is home prices and incomes in Canada. Now, if you've got a very large shortfall of homes, what happens is your income levels, if you compare it to the medium income level, then it's going to get a bigger and bigger gap, which means richer and richer people can only afford the homes in that type of area. That is, by definition, how a shortage resolves itself. It prices people out and the affordability goes to crap. Are we going to get this in America, this similar move? I don't know. We'll have to wait and see and see what happens. I do know Canada is adding a lot of immigrants. I do know that is happening. So maybe they have very bad housing shortages. His happy Hawaiian says this is true of housing, it's true of commodities. Structural supply deficits cannot be fixed by temporarily suppressing prices via interest rate hikes. Higher prices are the cure to higher prices. And with time it takes to get new mines to production, this delay is costly. And again, supply rising is the best way to fight inflation. Here's the problem though. Supply rising is inflation. And I don't know if he knows that. New loans against new supply is inflation. So rising supply does not beat inflation, at least in the expansion phase of real estate, it's not. So it will, in the end, be the cure, but it won't be in the short term as loans go against those new homes and assets. It will actually increase the inflation. It will be the very thing that's increasing the credit supply in the system. Says, aren't we having an artificial intelligence boom that should demand qualified mathematicians and programmers? The jobs data, to the contrary, is strongly indicative of another tech bubble market top. In my firm's analysis, the AI version is bigger than the 2000 internet peak. And look at this, guys. This is the Indeed job postings by index sector. Information design, documentation, mathematics, and software development, all going back down. So it is a tech sector flush out. This is what we saw in the 2000s, early 2000s. Then they're going to lower interest rates. This is going to bottom and come back up, and the housing market's going to rip. That's what I'm seeing. Again, Logan, inventory in 05 was 2.5 million. Inventory in 07 was 4 million. Inventory in 2023 is 1 million. Down year over year, unlike 05, 08, where we saw the biggest spike in supply in decades. This is why I don't use 2008 models since 2008, because of this big supply spike. We're down here, guys. We're below everything in the 80s and 90s and 2000s. This is probably the lowest inventory level we've ever seen. But hey, we're in a housing bubble with the lowest inventory we've ever seen in history. Yeah, sure. He says, hey, is there a reason you forgot to mention, forgot should be one word, but whatever. Forgot to mention that in 2008, it took 6 quarters from the start of the rate hikes for prices to start going down. We are only 5 quarters into this hiking cycle. So unless you expect this, He just doesn't know what's going on. It's as simple as that. He just doesn't know what's going on. Inventory is what drives pricing. It's the supply and demand. Interest rates are not impacting this inventory level. So you will not see, I think you won't see a gigantic crash in home prices because of that. But that's where I'm going to end it, guys. That's what I've got for today. Thumb up for the content. Subscribe to the channel. Subscribe to the website. And we'll catch you guys later. Don't forget, it's in the link below. If you want to join, it's going to be a birthday coupon code. So we'll see you guys later. Catch you later. This is Finding Value.